Good morning, Monday, November 17th. And on my journey to creating a podcast, this is the second episode. I wanted to record another episode today. It's a big week. Nvidia is on tap this week with earnings on Wednesday after the close. I actually talked to Sanjay this morning, like I do most days. And he mentioned to me over the weekend there was a really good podcast. So I want to point this out as a takeaway. But I haven't listened to it yet. It's called Odd Lots. This particular episode is why Paul Kudrowski says the AI bubble is like every bubble all rolled into one. The title resonates with me because I think the same thing. I think this is the mother of all bubbles. It not only constitutes a stock market bubble, uh, private equity capital bubble, venture capital bubble, um, but there's also been a ton of capital that's flowed into the U.S. from overseas, which is very similar to what happened with Japan at its market peak in 1989. I'm going to do another episode tomorrow, and I'm going to talk about Nvidia more, on Tuesday. And the last public article I actually wrote for Seeking Alpha was not the contrarian, where I've written more frequently, about once a week. Right now I'm on pace. But the last public article I wrote for Seeking Alpha, I printed it out. I actually read it this morning. And when I got up, Monday's always busy, getting kids off to school. And I've got some older kids now, too, that driving age and up, but always kind of chaotic. So run some errands. But the first thing, I was up before everybody. And I read this article that I had written, which I titled "Nvidia is still historically overvalued with negative catalyst developing." This was July 18th, 2024. Market cap of Nvidia at the time was 2.9 trillion. Today it's 4.6 trillion. And I'm going to walk through this tomorrow in a separate episode because I think it's really compelling. But I want to point out a couple things. When I wrote about it, and this was 487 days ago, the 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 price to sales multiple for the current year earnings was 24, which I thought, again, way above the Scott McNeely 10 threshold where an investor can make a positive return. It was 24 back then. Today, 4.61 trillion market cap, as I was, kind of getting together this morning. It's 22 times this year's sales, so it's kind of, gone down a little bit. That multiple is compressed. But the expectations are really high. There's huge expectations for Nvidia to beat. It reminds me of Palantir, where Palantir has just had an extraordinary run. It's traded up to over 100 times price to sales here recently. It's amazing because you do discounted cash flow modeling for it, and you can come up with stock prices much lower. And on that note, Alex Karp, the CEO, who kind of had a meltdown for Michael Burry short selling Palantir here recently, Alex Karp sold $2 billion of stock of Palantir at $48 in 2024. Huge stock sale. So at that time, he thought that 48 was pretty good. And obviously, Palantir had gone way above that, above $200 a share. But going into their earnings, expectations were really high. They beat across the board, and they sold off. And now Palantir's orders of magnitude, more expensive than what Nvidia is. But it's extraordinary to have a large cap stock, sell. I mean, the market's biggest capitalization stock sell at 22 times sales. People forget. I mean, in 2021 at the market peak, Apple was the biggest stock. Huge amount of speculation back then with all the SPACs. Apple peaked at like 2.7 trillion. Then somewhere around there. Microsoft's at 2.4. Nvidia actual peak was 846 billion in November of 2021. Excuse me. We got my tea. I'm a little stuffed up, but Nvidia went down 66%. From the 21 peak into 2022. People forget that. Historically, semiconductors are very cyclical. It's going to be really interesting to see how this plays out. And again, we'll talk more about that tomorrow. But I wanted to lead off with that, because obviously that the takeaway for that podcast, where it says the AI bubbles, all the bubbles rolled into one. But second, what kind of happened was, I want to go through some market history, and I don't know if I'm going to continue with this trend, but I like the Monday market historian, And you know, the Nvidia echo bubble, because remember the stock market bottomed in October of 2022, and then OpenAI came out with ChatGPT in November of 2022, and then Nvidia came out and said in May of 2023 that hey, there's going to be this whole new wave of spending, and it's going to create another massive bubble. They didn't say a bubble, but they said there's going to be it's going to create a massive wave of investment. And they were right. But what that did was, we had this first bubble peak in 2021 in the U.S. where the market cap to GDP, the Buffett ratio, got up to like 220%, and then you know, we went down from there. And really, the market cap to GDP, or that GDP ratio, is a little bit less now, but we're in a bigger bubble. Obviously, the market caps of the biggest stocks are bigger, and for all of us, contrarians who are in the energy sector have been. It's interesting that the market cap of the energy stocks is less now in the S&P than it was, when at 2020, 2021, and that's because the market cap of the biggest stocks have just got, so big and they've swelled up. So it's actually more contrarian in some ways to be long, energy today than it was even back at the depths, in 2020 and 2021. So, we've had this U.S. first bubble peak in 2021. It burst. The Nvidia's kind of reinflated that, and by most metrics today, the price to replacement value, things like that, price to book value, price to sales. We've reached a point where over 40% of the S&P traded at over 10 times price to sales. We're much more expensive than we were in 2021. And you could argue that the bubble's bigger, right? And the argument against that is that the biggest companies have a lot of earnings, but remember, earnings can be manipulated much more than cash flows, and the free cash flows for these companies are, for the biggest ones, are all, Meta and Amazon are negative now from free cash flow standpoint, and even Microsoft, is 1.5%, Apple 2%, so they're all in low single digits or negative. So the free cash flow yields look a lot worse than the earnings yields. So, but I want to compare this to Japan, because what happened in Japan is the Nikkei peaked in 1989, and it took 34 years to get back to even. And when the Nikkei peaked, the biggest companies in the world were Japanese by market cap, which makes sense, right? And I was actually looking this up this morning, but the Japanese share of global GDP was 18% at the market peak in 1989. It actually peaked in the low 20% range in the early 1990s. What do you think the U.S. share of global GDP is right now? I mean, rhetorical question, but if you're listening to this, what would you guess it was? So Japan peaked at 18%, actually in the low 20s, but the stock market peak was 18% in 1989. Well, the U.S. today is 15%, of global GDP, and the U.S. peak was actually 35% in 1944. So that's the percentage of GDP on a global basis. Now, the market cap percentage, the Japanese market, much smaller population than the U.S., peaked at 42% in 1989. We peaked at 65% here in 2025. We were around 62% in 2021. So again, you had that bubble that burst in 2021, and you had the echo bubble, that has been inflated. It hasn't burst yet, but you've seen a lot of the last 3 or 4 weeks, the second tier momentum names, where most of the most speculative price action is. That's you've seen big downturns there in things like Rigotti and Okla that we've talked about. So, but again, the comparison between 1989 Japan, 2025 U.S. Stock market, and really you could say the whole period. The 21 peak was one peak, and here we are again. With the second higher peak. Almost think like mountain ranges. This one's slightly higher in 2025, and it's pretty remarkable. But when Japan peaked, a lot of investors were around the world were investing in Japan. Same thing here in the U.S. If you look at the Korean stock exchanges or the Mexican stock exchanges, the amount of, if you look at their most traded issues on a daily basis, their top 10 is like Nvidia or Tesla, or derivatives of U.S. companies, derivatives of Nvidia and Tesla. So capital from around the world is flowed into the U.S. But interestingly, you know, up until this year, that it's kind of supported the dollar, but the dollar is down this year. I do think there is a coordinated effort to move the dollar lower. Kind of congested today, so I'm drinking my tea. You'll see my teacups in these videos. This is a red one, and I've got some tea and honey. But remember, in 1985, there was a Plaza Accord, which basically was a coordinated effort to lower the dollar against the yen, Japanese yen, and then the Deutsche Mark. And it almost seems like there's a coordinated effort this year to lower the dollar. We'll see how that plays out. I think a warning sign would be if the dollar gains strength, which it has a little bit the last couple of months. So, um, in summarizing, I think there's a lot more parallels to 1989 Japan, and 2025 U.S. in the stock market. And when those fund flows reverse, what ultimately happened in Japan was the 42% peak of the global stock market for the Japanese equities, they reverted all the way back down to 6%. The U.S. is, again, a bigger population, bigger economy. I'm not sure we'll revert that much. And there's a lot of undervalued securities under the surface in the U.S. that are opportunistic right now. But the market caps of the largest companies are so enormous. We mentioned that you have the 4 trillion companies: Nvidia, Microsoft, Apple, and go on down the list. But like the 500 biggest company in the S&P is like a $15 billion market capitalization. So even if there's an equal weight renaissance and a lot of stocks rebound, they won't be able to overcome the headwind if, in fact, we do have a peak in what I think is a huge bubble, technology bubble today. So that's my Monday morning market historian. I'm going to keep chopping away at these, doing these video updates as I work towards a more formal podcast. I'm going to try to find my rhythm, in a kind of a structure, both on a episode basis, but also within the episode. But I just want to freeform too, just basically talk to the audience, and it gives me a way to be creative with, that like this video is 13 minutes now. Some may be longer, depending on if I really get into a topic or I'm just flowing. Some may be shorter. I was thinking about doing like Fitness Fridays. I'm going to talk about the sauna. I've done the sauna a lot, and you can say, for example, how long sessions should be, what temperature should be, and but in general, we're going to focus on the markets and topics of my interest. And I love history. I love market history, and there's a lot to learn, and I think there's a lot to take away. And obviously, they're not history rhymes, doesn't always repeat. There's different circumstances, but and I think there's parallels also to the 2000 tech bubble, not only the Japanese 1989 peak here in the U.S. right now, and also the 1970s, where the Nifty 50, the top 10 companies were 40% of the S&P, even though the S&P really wasn't a thing. With indexing, there really wasn't much money indexed. The SPY, SPDR, S&P 500 ETF didn't come out till 1993. So even in 2000, there wasn't that much money indexed. So when we went through that correction, the S&P was down 42%, the NASDAQ down a lot more. I mean, even Amazon, one of the leading companies, they're an emerging tech company, but they went down 4% peak to bottom. So, but the whole NASDAQ composite was just crushed. And that was 2000. I wonder if we're going to get something similar, and how that plays out. Now, You could say, that, like, again, I wrote this article on Nvidia that I'm going to go through tomorrow, 487 days ago. In the scheme of market history, that's just a blip. It feels like forever, but really, I mean, even looking at it now, the S&P is up 21% since I wrote that. Nvidia is up 56. But that can change, depending on, obviously, I always say narrative follows price. You got a 66% correction in Nvidia from the 21 peak to the 22 bottom. That's been kind of typical. Microsoft, biggest company in 99, 2000, 70% down, into the lows of 2002 and repeated that in 2009. So, we'll see what happens. But obviously, if you get that type of percentage move down today, because of the sheer amount of passive, which is price insensitive and valuation insensitive, the downturn would be more dramatic. So there's more reward for being different today than the indices. There's more opportunity too. I think there's even more opportunity today than there was in 2000. We can find value names and find areas of the market that are interesting, regardless of what the market is doing. So with that, I'm going to wrap up. Thank you for listening. I appreciate the audience. Thankful and grateful for everybody in our group. I'm going to try to get onto the group chat later today. I got to do a couple things. I still have afternoon kid pickup, and almost all of mine are driving. Not quite. My two youngest aren't, but that's another hurdle, to go through. So thank you for your time. Hope everybody has a great start to the week. Look out for Nvidia, on Wednesday after the close, and then I'm going to listen to this podcast driving today, or running errands today. But the takeaway, that Odd Lots, the why Paul Katrowski says AI is like every bubble all rolled into one. I've had multiple people, including Sanjay, say, "Hey, you've got to listen to this." So it's on my to-do list, and we'll go from there. Have a great Monday, guys.